So today I'd like to talk about a pitfall that happens with market neutral options traders involving flip-flopping on your trade, flip-flopping specifically on adjustments. And this all came about as a result of a mentoring session I had with one of my traders on our desk. And he talked about how he had just put an adjustment on, an upside adjustment on a trade, and right after he put the adjustment on, the market sold off. And he said he was considering reversing the adjustment. You know, he sold a put credit spread, so he was talking about buying it back. And it came about because he was concerned that the market was in the middle of a big sell-off all of a sudden right after he put his upside adjustment on. However, he said, I restrained myself from doing that, and I'm very happy I did, because the next day after the sell-off, there was a big rally. And so his adjustment ended up becoming favorable for him. Well, in his comments, he said, I've learned not to flip-flop on trades. And it's a really wise point, and I think it's something that everybody should consider. So let's talk about flip-flopping on an adjustment. First of all, whenever you are putting on an adjustment, let's say you're selling a put credit spread to increase the positive deltas in your trade. You're going to get filled on that almost definitely when the market is intraday selling off. All right? They're not going to fill you on a put credit spread when the market's rallying unless you lower your price ridiculously. But assuming you're trying to get a reasonable price, you're actually going to get filled on that adjustment when the market is selling off. So by definition, the first move the market's going to make after your adjustment is going to be against your adjustment. All right? So that is one reason that flip-flopping makes no sense. You're not even going to get filled on your adjustment if there isn't some kind of an adverse movement against your what you're trying to accomplish. Second of all, oftentimes the market will in fact retrace after, in this example, a big rally. So assuming it doesn't retrace so badly that your adjustment really started to get you into big trouble, which can happen, but usually doesn't happen, then you're better off sticking with the adjustment in the first place. But most importantly, flip-flopping is a sign that you're not following your plan and that you're being emotional. The only reason you'd flip-flop is because you got emotional. You know the market is going to fluctuate. So to take the position that I put an adjustment on and the market went against me immediately, woe is me, I better reverse it, is not really sensible trading, because there are always, of course, temporary reversals of any move that the market's making. So what's the downside to flip-flopping? And the downside to flip-flopping is it's a trap. Because once you've started to flip-flop, once you've done an adjustment and then regretted it, essentially, which is what this is about, regretting what you just did, what you've done is you've actually exhibited a lack of faith in your own plan, which means you've gone off the rails of your plan. And once you do that, most likely every step you take after that is also going to be emotional. Does this sound familiar? You sell a put credit spread to add positive deltas to your trade. Then the market sells off and you get scared and you buy it back for a much higher price than you sold it for. Then a couple hours later, the market rallies again. You decide your adjustment was a good idea in the first place. You sell it again, but now you're selling it for less of a credit than the credit you got originally. All right? So let's give a numerical example. You sold the put credit spread for $1. Then you bought it back for $1.20, losing 20 cents per spread as you did that. Then the market rallied again, but now it's later in the day. Volatility has come out, and now you're not going to get $1 when you sell it. Now this time you got only 85 cents. So guess what? You just cost yourself 35 cents per spread by flip-flopping on your adjustment. You sold it for $1, you paid 20 cents to get out of it, then you resold it for a lower charge, a lower credit. And so the whole round trip of your flip-flopping and emotional trading cost you $35 per spread, plus commissions that were absolutely pointlessly spent because you never should have done anything but put the first adjustment on in the first place. So what's the worst part of this? The worst part of it is that you can actually, by flip-flopping on a trade, hit your maximum loss when you absolutely didn't need to because of the culmination or the combination of losses that you took as a result of purely your flip-flopping. If you had not flip-flopped, you well may have avoided max loss and the trade could well have become profitable. At a minimum, it prevents you from hitting your target. If you flip-flop a lot on a trade, it's going to be very difficult to hit your target because you've now made the bar higher by the amount of the costs plus the commissions of your flip-flops. So don't be a flip-flopper. When you make a decision, you're making it based on what? You're making it based on your system, your back tests. If you have back tested carefully and ran this through lots of different market cycles and it's a solid system, then the fact that the market temporarily goes against an adjustment of yours, which is almost inevitable, should not in any way cause you to deviate from your plan. And once you've deviated from your plan, that becomes a slippery slope and you start panicking in either direction, which creates the cost of flip-flopping. So don't be a flip-flopper. Trust your plan, trust your system, allow it to play out, and most of the time it will be favorable for you.